I just want to start with just precursoring as part of my history, if you like. It was out of the failure of the Sydney gas bed by QGC in May that led to us doing a rights issue at QGC within a month or two. That then led to a Santos takeover, and we moved from 20 cents a share to the takeover price of $1.26 within 4 months of the abject failure. That failure continued once interest in the company continued with $1.63, I think, 28% take of AGL, and that got rid of the takeover premium, and then 18 months later sold not to AGL but BG for $5.75. So at the end of the day, sometimes failure is a precondition to success. And clearly we at Central have the same management team that I had at QGC. What I will do is skirt across to precisely where the company is and where it's going. In 2013, I was extremely concerned that oil price would collapse to below $60 US a barrel. At that stage, it was running around about 105 to 110. I was convinced of that, but I was also convinced ever since 2007 that the maximum number of trains that should be built at Gladstone was 4, and that was all the market could take, and have been saying that consistently since 2007. As one of the proponents of the LNG plants, I think that I had some data upon which to draw. So I was absolutely convinced that there was going to be a shortfall and a price shock that was going to occur to Australia in and around 2017, 2018. So we set out a strategy that moved from an oil explorer, essentially, with farming out with Total and Santos, so that we were able to meet our permit commitments, to trying to ensure that we could participate in what we thought was a known gas shortage. As a company with no balance sheet, we obviously weren't able to acquire assets that were already connected into the market, and as a Northern Territory-based company, focused company, we were able to acquire, with Macquarie's debt, our first gas producing assets at Palm Valley and Dingo. From then, it became a march towards ensuring, one, that the equity markets began to appreciate the same vision as we did, that there would be an energy crisis at around this period of time, and to ensure that our acreage became interconnected with the eastern seaboard where the shortage was. The ACCC inquiry, the Productivity Commission and NIGI were all launched from COAG. We were then able to finish our Dingo development and come on stream, and then we were able to purchase 50% of Mereenie, the largest onshore oil and gas field ever discovered, and been there since 1980. In production since the 1980s, and so you can see that with Mereenie, however, from 2009, it lost its Northern Territory contracts, and so moved from being around about 50 terajoules a day production, which is around about 18 petajoules, down to a minimal 8 or 9 terajoules a day, and gas became a safety issue. We completed the Macquarie acquisition in September, and Gemini was awarded the Northern Gas Pipeline in November 2015, and under that award it needs to commission, be operational if it's going to avoid substantial liquidated damages by January 2019, and on the 12th of July had a groundbreaking ceremony as it's commenced to lay the steel in the ground. In April 2016, the ACCC confirmed our hypothesis that there was a shortage and that the market was not properly functioning. after the election, we then sought to influence COAG yet again to try and ensure that there was a proper inquiry into what is the cost structure of the industry, on the basis that two things: if the domestic economy has to get used to international netback pricing, then it should have the supply chain equally exposed to international competition pressures and be internationally comparative, and that was certainly necessary, as well as capacity constraints or capacity hoarding being undertaken, and to recognise that if you are going to be bringing in the next most marginal fields, they were always going to either be geologically or geographically disadvantaged from incumbent producers, otherwise they would have been on stream, and that the geographic could be overcome to some extent if we had international pipeline tariffs. We then had Burdekin recommending the pipeline reforms, and that process is still ongoing. Macquarie then acquired 50% of Mereenie from Santos. Now that in itself is a yin and a yang event, in the sense that clearly we were in a scheme of arrangement, and to have a joint venture, and the marketing that had been set up with Santos' weather eye to trying to become the marketer for the gas, and to try and ensure that we had a time pressure to give them marketing rights. Now that meant that area was still work to be done, work in progress. But the beauty about Macquarie acquiring the 50% is we know what their motives are. Their motives are purely they want to make money. And that is a motive which I share. I've always maintained that joint ventures were invented by the devil to replace bunkers in golf, very easy to get into, impossible to get out of, and you sometimes lose your balls in the process. So if you at least can understand precisely what your joint venturer's motive is, to make money, and there's no, I'm trying to show you I'm a better technical person or a better marketer than you are, you really have a much better joint venture than where the motives can be mixed. We then, in the middle of the scheme of arrangement, announced another contract, and that basically is for another 10 petajoules, and that has made us unambiguously cash flow positive. So basically, that was all called the GAP program. It was all leading to the condition precedents to try and get to a stage where we could further develop reserves. Now, you can't develop reserves unless you have a market. The home heating in Darwin is slightly less than in Canberra, even if they have an equivalent population. So clearly, to increase reserves requires clear line of sight to a market for reserve certified to be comfortable that you can commercialise it, as well as to have the money. So for the 12-inch pipeline that has been selected, only 30 terajoules a day have been committed, and there's another 60 terajoules available, and it can go up to 160, which would be an increment of 130 terajoules a day available. Now, essentially, in the meantime, the Northern Territory government changed, and a fracking moratorium was imposed. They have, by regulations, defined that unconventional means CSG and shale gas. So whatever may be the technical meaning of unconventional, I can assure you that in the eyes of the Northern Territory law, I am probably the most conventional gas man you have ever met, because we are clearly not shale gas or CSG. So we have got ourselves into a position where we're the only onshore gas producer in the Northern Territory with 60 terajoules a day of unfulfilled capacity in a pipeline that's going to come about in 2018, end of 2018. The only other physical supplier can be black tip out of the offshore Northern Territory, and is contracted to PwC. And under the PwC arrangement, they have basically pre-sold most of that production through underwriting NIGI. So basically, we made sure that we were avoiding the moratorium by becoming sensitive new age men. We have converted the workforce from 93% FIFO to 1/3 local Indigenous, 1/3 local non-Indigenous and 1/3 FIFO, and we've increased our economic activity by around about $2.3 million annually into the local economy, which means that if they want to close us down because of the sentiment in inner city Melbourne or Sydney, they have to, in their conscience, take that they are making unemployed the most disadvantaged, dysfunctional group, and if they can wear that to their conscience, well, God bless them. And no wonder I don't want to live in the same surrounds. The simple fact is, it is not a good picture for them to paint, and so they'll pick on someone else. But we have always been looking at enhancing our reserve base and have done a lot of work on the stairway formation, which overlays the present existing production formation and has been treated as a safety hazard because it's full of gas and you're trying to get oil over the last 20 to 30 years. We have been able to have free-flowing wells from the stairway in the past and have clearly demonstrated that it has gas in it, and have modelled the natural fractures in it, and believe that a horizontal drilling program which intersects those natural fractures should access a large amount of gas. In the scheme of arrangement, page 26 of the risk report, they maintain that our modelling has been well and truly, and the history matching of that modelling is extremely robust. So in this presentation, most of the figures, etc., that I will give have actually been third-party corroborated through the scheme of arrangement documentation. We have made ourselves cash flow positive. We have targeted reserves of 446, most of which, as I said, is third-party corroborated. And we are progressing to overcome the marketing imbroglio or what was inherited, so that there is no impediments to market Mereenie. But if this project works, we also have the price of independence. So basically what we've been able to identify, once the modelling was shown to be robust by risk, in May we started to do the same work on Palm Valley, and that is presently under audit. So the numbers, other than for Palm Valley Shallow, are all out of the scheme documents, which themselves have risk factors attached to it. If we start with the fact that we have existing reserves of 125.9, and we are looking at 3 targets with a 4-well program, but because Mereenie is 50-50 Macquarie ourselves, one of those wells will be paid by Macquarie, one will be paid by ourselves. So we talk at the net to central thing. You can see that if this program where we're going for known gas reserves, so whether it's gas bearing is not a problem, for brownfield development, and some are more brown than others. If you take Mereenie, for example, on the Mereenie wells, we will tie the drilling well in on drilling, so that we won't have to flare it. It's that ready for commercialisation. And the same will happen, we believe, on Palm Valley Shallow. Oromina is sort of less brown in the sense that whilst it has 2 wells already proving the gas exists, we will need to tie it through the Dingo pipeline into the existing processing plant. So it's not as brownfield as the other 2. But you can see that that would move us from a 125.9, which is what's in the scheme documents, petajoules of existing reserves, to a possible 353 to 540 odd petajoules. In addition to that, what it does do is that it will decrease the costs of the Mereenie ex-field production to well below $1.50 a gigajoule. The prime reason for that is that there was $200 million worth of field development, etc., processing plant that we purchased for $50 million. So everyone else has to spend that money, and that's on the assumption that all we bought was the field gathering and the processing plant, and we got the reserves for free, which is not an accurate assumption to make. So clearly, as we see it, there is an existing gas shortage that we foreshadowed right back when we started this program. For us to close this program off, we need to do the drilling of 4 wells, which are extremely low risk. If we do it sooner rather than later, that gas can be delivered into the NGP on commissioning, and so it will have an extremely quick commercialisation path. There won't be the valley of death that normally occurs after a discovery. Oh my God, is there going to be a cost overrun? Are they going to be on time? The stuff is already there. We will obviously need to upgrade the plant over time, but it doesn't have to happen before we deliver the gas. And you can see that this is a program that can, from drilling to sales, is going to be less than 12 months, or could well be less than 12 months. So that is pretty bloody rapid. The only question is whether you believe there is a gas shortage or an energy crisis in Australia. If you don't believe that, you haven't been reading anything in the newspapers whatsoever. So the next few slides, and if there's any questions to it, I'll get Mike Harrington to do it, actually show in the presentation precisely where we're looking at, and you can see that the most likely reserves are pretty interesting. The political pressure for pipeline reform remains unabated. On the 22nd of August is the closing of submissions on the 2 most critical pipelines that we have, that we're exposed to, the Carpentaria and the Amadeus gas pipeline. We always saw within the tariff reform there was 3 issues. One was the actual tariffs, and we identified, and we now have Shell on our side, that the dysfunctionality was that the capital was amortised over 15 years, and that was the initial base of the tariff, but then you depreciated that pipeline over 80 years so that every 15 years you paid for a new pipeline, essentially. So it's the incompatibility of a 15-year amortisation period and an 80-year depreciation period that is causing us to pay double or triple international pricing. The second one was always capacity. The 5 daughters have always held up all the capacity, APA, AGL, Bass Strait, Santos and Origin. And so if you're a new entrant, you can't use that capacity. It's either been contracted or owned. And again, that means that you've got a degree to which the market is being forced to be bilateral and to take or pay long-term reservations on the contract, and that doesn't appear in any other mature jurisdiction. And the third was the lack of backhaul. Now, clearly the AEMC inquiry will now will cover some of that which went through the Vertican process, the GMRG, but the prime issue in front of it is going to be backhaul. So presently, under the present scenario, if we put gas through the Carpentaria pipeline, APA will see somewhere around about a 2/3 drop in their operating costs and a 78% increase in their revenue, because they can charge forward haul and back haul, but end up transporting only actually physically transporting around about 20% of the gas. And that is adding somewhere around about $2 a gigajoule to what the manufacturer is paying in Sydney, with no real logic attached to it. If that did occur, that backhaul got recognised as it does in other jurisdictions, the Northern Territory will be the prime beneficiary, and we have a monopoly on the onshore Northern Territory market. So very, very important to us. You can see that we worked extremely hard to try and make sure that we're cash flow positive. That was made more difficult, if you like, by the collapse in oil prices as predicted. And so you needed to ensure that there was tight fiscal discipline, and we have clearly been able to achieve ourselves to a cash flow positive. There is a little bit of lumpiness next year, but essentially it's only for one quarter, and we're cash flow positive over the year. That is, of course, no problems at all in managing. The next slide, it's been updated on the ASX since then, but the next slide also covers how the detail of that cash flow gap being closed. So by the end of the year, we will have upgraded the Dingo plant primarily with a triethylene glycol unit. This will enable the Oromina to be able to come in a lot easier, and coincides with the Owen Spring Power Station being upgraded. We believe that in the next 6 months, the marketing arrangements with Macquarie will be well and truly sorted out. We will have secured our funding sources, and we will have commenced those those 4-well program. And we intend, as we continue to change in company from essentially just an oil exploration company to a predominantly gas producing company, that the skill set on the board needs to get augmented as you go through that transition. So that's where we're at, and all we can say is that we have been consistently since 2013 going for this gap program. We think that the nation should keep calm and mind the gap, which is why the earlier slide that I put up looked like a tube map as to where we're at. So, my apologies to London in all due respects, but we will beat them and the Ashes.